Hello, traders. I hope you have been doing well. We are approaching almost the summer. Those of you who are in winter states, I hope your snow and rain will go away soon, or the snow will melt and the sky will open up. You'll get some sunshine. Myself, I'm in Florida, so we always have sun here, but we're going to have very humid summer, like every summer. We've learned to live with it. At least I learned to live with it. That's fine. But, just to tell you that nobody always has it perfect, right? So we have it very well here during the winter months, but when the summer comes around, it's like living in a microwave. So we all have to endure certain things. So today's podcast is going to be about thinking in terms of relative terms, statistical probability versus absolute terms. So basically what I want to do is take you away from the approach of thinking of the market as some sort of a fixed asset class and really start thinking more in terms of probability. And I'm going to use a very specific example first, which is outside of trading, and then I'm going to relate it to trading. So imagine there's a baseball player who comes at night to the baseball field to train. And many times they use those automated machines that throw the ball, right? So the baseball player stands there, the athlete, he stands with the baseball bat, and as soon as the ball comes his way, he hits the ball, right? So every single time he hits the ball, it will go in a different, it will go to a different place. I don't mean it goes in the same direction, but it will go in different places, right? It can never be the same. But you start asking yourself, well, why is it not the same? Well, if the machine is standing there, and it throws balls at a certain speed, it's fixed. Well, let's assume he didn't get tired for the first 10 hits or maybe first 100 hits. Pretty much, it comes the same way. He's supposed to hit it the same way. But every single time, it would go slightly in a different direction, right? And so essentially, you can never say that even with fixed things happening, you can expect the same outcome every single time. So that brings me to trading now. So beginners have this mental block, not understanding why, when they obey the rules 100%, wait for the setup, execute the setup, the trading results are basically different from what they expected, from what they tested, from what they paper traded, and it just kind of leaves them in a state of confusion. So again, the idea is not to think of the market in terms of a fixed type of return, but rather a statistical probability. Let's go back for a minute to the guy who hits the balls from the baseball machine. If you think about it, even if the machine is not that fixed, right? So the ball stands in a certain angle when it gets hit. It could be slightly off. It could be by millimeters. It can be by centimeters, but it's positioned there, but it could be a little bit different, right? And when it leaves the machine, basically it could have 1 millisecond or 1 second less in its velocity, right, in its speed. When the baseball player hits the ball, he could have slightly a different angle, slightly differently the way he holds the bat. He could hold it very tight or very loose, which will affect it as well. So even in the world where you think things are fixed, they're not that fixed. So the way to think about any trade setup is to think about it in terms of probability. You're not going to think it has to happen. You have to think is what is likely to happen. and it could happen and it may not. And why is it very important to understand this concept? Because essentially you're dealing with statistics. And when you deal with statistics and probability, you cannot guess what outcome will be for any given setup. The only thing you can do is follow the setup. And if you think that in the long run you'll have more gains than losers, then you have to basically obey the rules and take the setup. Just like the baseball hitter has to hit the ball when it comes, because he doesn't know whether his next hit is the best one that he ever had and will prepare him to be a champion. And you have to think of trading this way as well. Every time there's a setup, you're not guaranteed, to make a profit, but you have to take the trade. What happens in reality? In reality, traders are starting to doubt their skills because of that, right? Or their setup. So let me give you an example. Let's say somebody backtested, let's say 1,000 trades, okay? And 1,000 setups, okay? And within those 1,000 setups, there's a certain statistics that they gathered and everything else. So this setup is for the 1,000 trades. It is not for one trade. So your next trade, in terms of relevance to the overall method, really is not that relevant in terms of statistics, because it's just one trade. So even if this trade was the best that you've ever had, it doesn't mean that your setup is good. It could be because, at the same time there was some sort of an announcement and you lucked out. And at the same time, if it was a trade, for example, that was not profitable, if you lost on the trade, it doesn't mean that your trade setup is bad. So you have to start thinking of every single trade in terms of probability, not in terms of absolute terms. It is very discouraging, I would say, if you come with a very fixed approach to the market, in terms of fixed return, where you say, okay, if I'm going to follow these rules, the market will give me $200, $500, $50, $1,000. That kind of a fixed thinking could really discourage you, and then you will become very selective about the trades that you make. And when I mean being selective, I mean intuitively selective. And in previous podcasts, I told you what I think about intuition. It's a very misleading thing. So you can lose on the first trade, lose on the second trade, lose on the third trade, and on the fourth trade, you could potentially make it all back. But, if the fourth trade is a loser, it's very hard to take the fifth trade. And if the fifth trade is a loser, it's very hard to take the sixth trade. And I get it. But that's the difficulty, and that's the challenge of trading, that you never have a certainty. And every single step of the way, it's a psychological game of being strong enough, or maybe it's not the right word to be strong enough, because, but maybe it is. Maybe it is to be strong enough and not take those trades personally. Because if you do, then you stop, and then the winners may come. So you have to know ahead of time with your setups, and when you test it, how many times it might not work out. Does it not work out 60% of the time? Does it not work out 40% of the time? But if in the long run, after transaction cost and everything else, you remain profitable, it really means that you have to take every single trade. Now, a lot of traders, what they do when they backtest, they just look at the overall results and they see what they want to see, right? So we call it confirmation bias. And for me, this game is a lot about your mental state of mind and the risk management. Think about it. You don't control what the market will do after the setup, but you can control your psychological setup, right? Your mentality, your strength of your mentality, and then basically controlling your risk. So when you're in a trade, the only thing you can control is risk. So you control risk, you work on your psychology, you prepare yourself ahead of time that something might not work out, or any trade might not work out. And what you want to do out of any number of trades that you do is keep on minimizing the losses. Minimize, 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 minimize until such time where you have better trades that come along. So again, think of the market in terms of a fixed, don't think of the market in terms of a fixed asset. Think about it as a probability asset and a probability outcome. And that would help you out a lot, in terms of your psychological composition when you trade. This whole entire episode was actually inspired by a conversation that took place between one beginner trader and one experienced trader. If you go to community.optimusfutures.com, you will be able to see the thread over there where it says different trading volume, same different volume trading, different trading results. And there's a handle there, a user in our forum by the name of Trader that has a really good approach to this. And, the person who posted it did not understand why he lost. He showed a certain setup in order flow and Trader. That's his kind of handle on the forum. Very lucky to grab that. Basically started talking in terms of probability. He's more experienced and he's probably a profitable trader. And he explained to him how you can't have this kind of a mindset, of expectations from the market. You just can't do that, right? You can't say, well, I did this exactly. The market should do this and give me this. The market doesn't owe anybody anything. And there is a real cost to trading in the market. The real cost is not always your, it's money. It's really the emotional capital. And this is what you have to preserve a lot. When your energy is focused on the market has to give me money and it doesn't, it's discouraging. Your emotional capital will be drained really fast. And it could be drained much faster than your actual money, and which affects your performance, which affects the way you think and everything else. So again, if you have any trading issues, or if you want to share your story as a trader or the dilemmas you're going through, again, go to community.optimusfutures.com. I want to encourage you to call us. If you're looking for a broker, would love to earn your business. It's www.optimusfutures.com. You can always call us at 1-800-771-6748. We also have a local number, which is 561-367-8686. Want to remind everyone, when you trade futures, only trade risk capital. Don't put yourself or your family at any risk that you cannot afford to take. That's number one. And remember that there's a substantial risk of loss in futures trading. And past performance, regardless of what you go through in your models, past performance is not indicative of future results. I wish you well, and I look forward to hearing from you. Thank you.